Hare Krishna. Welcome to Tax Guru YouTube channel. This is CA Rohan R. Pingale, practicing chartered accountant based in Mumbai. Also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to video series What Law Says. And today we are going to discuss case laws under direct tax reported to ITAT and High Court. So let's dive into it. Let me allow to share my screen. What law says? Direct tax case laws reported to ITAT and High Court Part 11. Let's start. Today's first case, ACIT versus Merilina Foundation, Delhi, 2025, assessment year 2011-12, date of order 9th September 2025, and relevant section is section 54F. Let's understand facts and issue of the case. The assessee was a private trust set up for identified beneficiaries. The trust sold a flat, that is capital asset, and claimed exemption under section 54F, capital gains exemption on investment in a residential house. During reassessment under section 147, the AO denied the 54F deduction on the ground that the section 54F applies only to individuals or HUFs and not to trust. So the CIT appeals allowed the claim, the revenue appealed. So issue under consideration was whether a private trust with identified beneficiaries is eligible to claim exemption under section 54F when it invests sale proceeds of a capital asset in a residential house. Very important. Let's see what tribunal observed and held. The tribunal held that a private trust for identified persons can claim the exemption under section 54F provided the conditions of investments in a residential house are satisfied. It reasoned that the identity of the entity should not prevent access to the exemption if it acts akin to an individual or HUF for the purpose of statute. The disallowance by was set aside. The exemption under section 54F was allowed. Next, Imperial College India Foundation versus ITO Mumbai 2025. Relevant assessment year is 2016-17 and date of order is 10th September 2025. Relevant section is section 11 subsection 2. Let's understand facts and issue of the case. The assessee was a company registered under section 8 of the Companies Act, engaged in educational activities, that is granting what scholarships in assessment year 2016-17. It accumulated income under section 11 subsection 2 by filing form number 10 with a purpose stated as for objects of the trust. The AO disallowed approximately 62 lakhs of accumulated income under section 11 subsection 2 on the ground that the purpose in form 10 was vague or unspecified. So issue was whether a vague purpose stated in the accumulation application, that is form 10, is fatal to claim under section 11 subsection 2, where subsequent documents or resolutions show specific purpose and actual utilization. Very important and very interesting. Let's see what tribunal observed and held. The tribunal held that the vagueness of purpose in form number 10 is not at all fatal if a board resolution specifies the actual purpose, that is example scholarship, and the funds are actually utilized for that purpose in subsequent years. So thus the accumulation under section 11 subsection 2 was upheld. What is important is the factual facts as a board resolution specifies that actual purpose, okay, and that funds are also actually utilized for that purpose in subsequent years. So in that case, the vagueness of purpose in form number 10 is not at all fatal. Next, ICG-IISU Alumni Association-bandhan versus CIT exams, Jaipur 2025. Relevant assessment year is not applicable. Date of order is 11 September 2025 and relevant section is section 12AA. Let's understand facts and issue of the case. The assessee was a company incorporated under section 8 of the Companies Act, functioning as an alumni association for two educational institutions. Okay, that is ICG and IISU Jaipur. The company applied in October 2020 for registration under section 12AA, that is charitable trust or institution, but CIT exempt rejected the application on grounds that the objects have elements of commercial or business nature and the benefit was for members only, not for the public at large. These are the grounds to reject the application. So the matter underwent appeals and remand. Ultimately, the ITAT heard the matter again. Issues were whether the Alumni Association qualifies as charitable institutions eligible for registration under Section 12AA. Is its benefit for public at large? Are its objects tainted with business commercial nature? And was the CIT exam's rejection justified? Very interesting. Let's see what tribunal observed and held. The tribunal held that the expression public includes a cross section of the public. It need not reach every person. What? Expression public includes a cross section of the public. It need not reach every person. The fact that no fees were charged, minimal activity, use of parent institution infrastructure, and two of the four preceding years showed deficit indicated lack of commercial or business nature. The absence of mobile numbers of beneficiaries or even absence of major expenses didn't go to the heart of genuineness when other credible evidence was present. The matter was what remanded back to CIT exams with directions to consider additional evidence and decide afresh in line with these observations. Next, DCIT versus Business Excellence Trust, Mumbai. Relevant assessment year is 2018-19 and date of order is 26th July 2024. Relevant section is section 10, subsection 38. Let's understand facts and issue of the case. The assessee trust, that is Business Excellence Trust, was registered as a venture capital fund (VCF) under SEBI regulations and invested in shares of a company unlisted at investment time and later sold them during September to November 2017, leading to long-term capital gain around approximately 247 crores. In the return, the trust claimed exemption of LTCG under Section 1023FB for VCF and alternative claim under Section 10 subsection 38 LTCG on equity shares. The AO disallowed 1023FB claim and further disallowed 10 subsection 38 on the ground that what STT was not paid at acquisition and the trust could not claim section 10 subsection 38. Very interesting. CIT appeals accepted exemption under section 10 subsection 38. The revenue appealed. So issue was whether the trust is eligible to claim under section 1038 for LTCG on sale of shares acquired even without STT paid at acquisition, and whether it can shift from 1023FB to 10 subsection 38 as alternate claim. Let's see what tribunal observed and held. The tribunal held that change of legal section from 1023FB to 1038 before the first appellate authority is mere change in legal basis, not a fresh claim, and hence permissible. What tribunal held is that the change of legal section before the first appellate authority is mere change in legal basis, not a fresh claim, and hence permissible. It further held that the relevant notification which restricted STT condition for certain shares didn't apply to the facts unlisted shares, and hence STT requirement didn't block exemption under section 10 subsection 38, because at the time of the acquisition the shares are unlisted, so the STT condition is not applicable that time, so you cannot bring that to must be followed, that STD must be paid. Accordingly, the trust was held eligible for exemption under section 10 subsection 38. The revenues appeal was dismissed. Next, DCIT versus Jammu and Kashmir Power Development Corporation Limited, Amritsar. Relevant assessment year is 2016-17 to assessment year 2018-19, and date of order is 15th May 2025, and relevant section is section 115 JB. Let's understand facts and issue of the case. The assessee company engaged in what? Generation and sale of electricity to the government of the state of Jammu and Kashmir. For computation of book profits under MAT, under section 115 JB, the company included a provision for CSR, that is corporate social responsibility, of approx 5.99 crores, that is 2% of average net profits in its balance sheet. The AO held that the CSR provision was an unascertained liability and therefore required to be added back for book profit under explanation 1 to section 115 JB. The CIT appeals deleted the addition, revenue appealed again. So issue was whether CSR expenditure or provision thereof, which is not an uncertain liability, should be added back for computation of book profits under section 115 JB is what issue under consideration. So let's see what tribunal observed and held. Book profit under section 115 JB must be computed strictly based on audited accounts under the Companies Act and cannot be adjusted beyond those items explicitly specified in expression 1 of section 115 JB. CSR expenditure or provision is not among the specified adjustment under explanation 1 and hence could not be added back. Accordingly, the additions made by you were deleted and revenues appeals were again dismissed. And now we are moving to cases reported to High Court. Let's start. Principal CIT versus Thomson Press India Limited. Relevant assessment year is 2014-15. Delhi High Court. Date of order is 2nd July 2025. And relevant section is section 56. Let's understand what was the issue. Whether an addition under section 50C, that is deeming value at a circle rate, is warranted when the agreement to sale was executed before a hike in circle rate, even though the sale deed was executed later. Very interesting. Whether an addition under section 56 is warranted when the agreement to sale was executed before a hike in circle rate, even though the sale deed was executed later. Let's see what Delhi High Court observed and held. The High Court held that since the registered agreement to sale and payment of stamp duty to was on 30th May 2013, that is before the circle rate was enhanced on 1st August 2013, the transaction value must be considered at then prevailing circle rate. Okay. Therefore, the addition under section 56 based on the latter higher circle rate was not justified at all. The court dismissed the revenues appeal, effectively upholding the ITAT's order in favor of the assessee. Next, CIT exemption versus United Way of Baroda. Relevant assessment year is 2015-16. Gujarat High Court. Date of order is 22nd January 2024, and relevant sections are section 2 subsection 15, section 11, section 12, and section 13 subsection 8. Let's see what was the issue of the case. Whether the assessee, a charitable trust, loses exemption under sections 11 or 2 because it organized Garba, that is dance events and food stalls, charging entry or stall fees, business activity under the proviso to section 2 subsection 50. Very interesting. Let's see what Gujarat High Court observed and held. The court rejected the department's argument. Despite revenue from ticket sales and food stalls, organizing cultural events didn't amount to a business activity for disqualification under proviso to Section 2, subsection 15. It noted that the assess's main object that is supporting NGO, human service, education, health are charitable, and these activities cannot be treated as a trade or business simply because there is some revenue. Hence, exemption under Section 11 and 12 was maintained. The appeal by the revenue was dismissed. Very, very interesting. Indian Merchants Chamber versus CIT exams. Relevant assessment year is 2014-15. Bombay High Court. Date of order 8 March 2024. Relevant sections are 2 subsection 15, 10 subsection 23, C clause 4, section 253 and 254. Let's see what was the issue. Whether Indian Merchants Chamber IMC can qualify for exemption under section 1023 C clause 4, that is institution established for charitable purpose, given the proviso to section 2 subsection 15, which might treat some of its activity as business. Let's see what Bombay High Court observed and held. The High Court held that IMC's core activities are what? Charitable, promoting trade, commerce, industry, and it doesn't carry out its meetings or seminars primarily for profit. The proviso to section 2 subsection 15 doesn't apply so as to deny exemptions under section 1023C clause 4 in IMC's case. Thus, IMC is entitled to exemption under section 1023C clause 4. Next, Vaibhav Maruti Dombale versus Assistant Registrar ITAT. Relevant assessment year is 1920. Bombay High Court. Date of order is 12th September 2025 and relevant sections are section 36 subsection 1 clause 5A, section 43B and section 254. Let's see what was the issue. Whether the ITAT was correct in recalling its earlier order under section 254 subsection 2 under IT Act based on a subsequent Supreme Court ruling in relation to disallowance of TFESI contributions by the CPC. Let's see what Bombay High Court observed and held. The High Court held that the powers under section 254 subsection 2, that is rectifications, are like review powers. That is Order 47, Rule 1 CPC. A subsequent ruling of a Supreme Court cannot be treated as a mistake apparent on the face of the record to recall the earlier order. Very, very important. Please note down. Subsequent ruling of the Supreme Court cannot be treated as a mistake apparent on the face of the record to recall the earlier order. So the ITAT's recall on that basis was held to be beyond its jurisdiction. The writ petition was allowed and the recall order set aside. Next, Principal CIT versus Polo Color Private Limited. Relevant assessment area is 2011-12. Bombay High Court. Date of order 16 September 2025. Relevant section is section 271 subsection 1 clause C. Let's see what was the issue. Whether penalty under section 271 subsection 1 clause C, that is a concealment or furnishing inaccurate particulars, can be levied when the assessment addition was based on ad hoc estimation, that is bogus purchases, but there is no clear finding of concealment or inaccuracy. So let's see what Bombay High Court observed and held. The court held that penalty under section 271 subsection 1 clause C cannot be imposed where the addition was purely on estimation and not on conclusive proof of concealment or falsity. It emphasized that assessment proceedings to determine income and penalty proceedings are independent and one cannot automatically equate an estimated addition to concealment. Therefore, the High Court allowed the assessee's appeal. The penalty was cancelled. UP Rajya Nirman Sahkari Sangh Limited versus Union of India 2025. Assessment year is 2009-10 to 2012-13. Allahabad High Court. Date of order is 8 October 2025. Let's see what was issued. Whether reassessment proceedings initiated after many years and without any fresh tangible material based only on an audit objection or departmental view of incorrect allowance of exhibition were valid under the Income Tax Act, whether the cooperative society engaged in construction of houses for government schemes could be denied exemption or deduction under the claim originally allowed during scrutiny, whether the reopening was merely a change of opinion and therefore bad in law. Let's see what Allahabad High Court observed and held. The court noted that no new material had emerged after completion of the original assessments. The entire basis for reopening was what? Only an internal audit objection. An audit objection indicating a different interpretation of law cannot constitute tangible material. An audit objection indicating a different interpretation of law cannot constitute tangible material required under Section 147 for reopening the completed assessment. The AO had previously considered the very same material during original assessment. Reopening on the same facts amounts to what? Pure change of opinion, which is impermissible. The long delay and mechanical recording of reasons showed what? Non-application of mind. The reasons didn't show what income had escaped assessment except vague references. So the reassessments were also inconsistent with the statutory requirement that the AO must independently satisfy himself, not merely act on an audit note or superior officer's direction. So reassessment notices and consequential proceedings were invalid because of what? They were based on no fresh tangible material. They represented only what? Only a change of opinion, and they were initiated mechanically on audit objection, no application of mind at all, without independent formation of belief. So the court quashed all sections 147, 148 notices and all reassessment orders issued for AY 910 to 1213 and 1516. The assessee's originally assessed position was what? Restored, and no further action under reassessment could be taken for these years. And that's it for today. We are moving to conclusions that can be drawn from today's learning. That is the one-liner conclusions from each case. Let's see. And if you want, you can take a screenshot of it. A private trust with identified beneficiaries is eligible for Section 54F exemption when it invests capital gain proceeds in residential house. Accumulation under Section 11 subsection 2 cannot be denied merely for vague wording in Form 10 if purpose and utilization clearly evidence. Alumni associations can qualify as charitable institutions where activities benefit a cross section of the public and lack commercial character. Change of exemption section is not a fresh claim. An LTCG exemption under Section 10, subsection 38 is allowable even where STT at acquisition conditions do not apply. CSR provision cannot be added back for MAT purposes since it is not listed in explanation 1 to section 115JB. Circle rate applicable on the date of the agreement, not the latter date of registration, must be used for section 50C. Invalidating the additions based on the increased rates on latter date. So revenue generating cultural events do not convert a charitable trust into a business entity. So exemption under section 11 or 12 cannot be denied. Trade promotion bodies remain charitable when activities are not profit driven, making them eligible for section 1023C clause 4 exemption. ITAT cannot recall an order on the basis of subsequent court judgment since such change is not a mistake apparent under section 254 subsection 2. Penalty for concealment cannot be levied where assessment additions are only based on estimation without proven inaccurate particulars. And reopening based solely on audit objection or change of opinion is invalid without fresh tangible material. So that's it for today. Please note down my contact numbers. If you have any queries, observations, suggestions, then do let me know via email, or you can also comment below the video. So Stay tuned to the Tax Guru YouTube channel. If you are not yet subscribed, then do subscribe it for latest updates and video series like this. Okay, so keep learning and take care of yourself. Bye bye. See you soon. Hare Krishna.